Bitcoin, often referred to as digital gold, is a form of money that exists entirely online. Unlike traditional currencies, Bitcoin isn't printed by governments or controlled by banks. It operates on a decentralized network called blockchain. Bitcoin is a type of cryptocurrency, a digital asset designed to work as a medium of exchange, using cryptography for secure transactions. Whether you're new to cryptocurrency or just curious about Bitcoin, this guide will help you understand what Bitcoin is, how it works, and why it's creating such a buzz in the financial world. The basics of Bitcoin. Bitcoin was created in 2008 by an anonymous person or group of people using the name Satoshi Nakamoto. The goal was to create a currency that was not controlled by governments or banks, but still trusted by people worldwide. In 2009, Nakamoto released Bitcoin's open source software, and the first Bitcoin transaction took. Why Bitcoin was created. Traditional currencies are managed by central banks, which can lead to inflation or devaluation. Bitcoin allows for peer to peer transactions, meaning no middleman is required, like a bank or payment processor. Transactions are transparent but private, recorded on a public ledger called the blockchain. 2. Understanding the blockchain technology. At the heart of Bitcoin is blockchain technology. So, what exactly is a blockchain? Blockchain is a public ledger that records all Bitcoin transactions in chronological order. It is decentralized, meaning no single entity controls the entire network. Each block in the blockchain contains a list of transactions. These blocks are linked together to form a chain. Miners, people who contribute computing power to the Bitcoin network, verify these transactions and add them to the blockchain. Why is blockchain important? It ensures transparency, security, and trust. Once a transaction is added to the blockchain, it's permanent and cannot be altered or erased. Since it's decentralized, there is no risk of a central authority tampering with the records. How Bitcoin works. Bitcoin operates on a peer to peer network, which means it allows users to send and receive funds directly without relying on a bank or financial institution. Bitcoin wallets. To send or receive Bitcoin, you need a Bitcoin wallet. There are two main types of wallets. 1. Hot wallets. Software based wallets that are connected to the internet. Example, mobile apps or web platforms. They're convenient but less secure than cold wallet. 2. Cold wallets. Offline wallets, such as hardware wallets or paper wallets, which store your Bitcoin offline and are much more secure. Bitcoin addresses. Each Bitcoin wallet has a unique Bitcoin address, a string of numbers and letters. This address is similar to an email address, where you send and receive Bitcoin. Bitcoin transactions. When you send Bitcoin, the transaction is broadcast to the network. Miners verify the transaction, ensuring that the person sending Bitcoin has enough to complete the transaction and that the transaction is legitimate. Once verified, the transaction is added to the blockchain. 4. Mining and how new Bitcoins are created. Bitcoin isn't printed like traditional currency. Instead, new Bitcoins are mined through a process called proof of work. Mining involves solving complex mathematical puzzles using computational power. When a puzzle is solved, a new block is added to the blockchain, and the miner is rewarded with newly minted Bitcoin. Bitcoin's block reward started at 50 BTC per block, but is halved approximately every 4 years in an event called the Bitcoin halving. Why mining is important. It keeps the Bitcoin network secure and operational. It ensures the distribution of new Bitcoin in a predictable and controlled way. 5. Bitcoin's limited supply. One of the most unique aspects of Bitcoin is its limited supply. There will only ever be 21 million Bitcoins in existence. This limited supply is programmed into the Bitcoin protocol and is one of the reasons why many consider Bitcoin a store of value, like gold. The scarcity of Bitcoin is expected to play a major role in its value over time, especially as demand increases. Bitcoin as a store of value. Bitcoin is often described as digital gold because it shares many of the same characteristics as gold, such as scarcity and the ability to hold value over time. Why people invest in Bitcoin. Hedge against inflation. Unlike traditional currencies, Bitcoin's supply is fixed, so it cannot be devalued by inflation. Store of value. Many people see Bitcoin as a safe place to store their wealth in times of economic uncertainty or crisis. Decentralization. Since Bitcoin isn't controlled by any central authority, people use it to protect their assets from potential government intervention or currency devaluation. 7. The volatility of Bitcoin. While Bitcoin has a lot of potential, it's also known for its price volatility. The price of Bitcoin can fluctuate wildly in short periods of time, sometimes by thousands of dollars in a single day. This volatility can be both an opportunity and a risk for investors. If you're thinking about investing in Bitcoin, here's what you should consider: market sentiment. Bitcoin's price is often driven by news, adoption, and investor sentiment. A positive news story can cause prices to surge, while bad news can lead to sharp declines. Long term investment. Many people believe that Bitcoin's long term potential outweighs its short term volatility. If you're considering investing, it's important to have a long term perspective. 8. How to buy Bitcoin. There are a few easy ways to buy Bitcoin, depending on where you live and your preferred method. 1. Cryptocurrency exchanges. Websites like Coinbase, Binance, and Kraken allow you to buy Bitcoin using traditional payment methods such as a bank transfer, credit card, or PayPal. 2. Bitcoin ATMs. Bitcoin ATMs allow you to exchange cash for Bitcoin. They are available in some major cities and are a convenient way to buy Bitcoin on the go. 3. Peer-to-peer. Platforms like local Bitcoins allow you to buy Bitcoin directly from other people. 4. Bitcoin debit cards. Some services allow you to load Bitcoin onto a prepaid debit card, which can be used just like a regular debit card for purchases. 9. How to use Bitcoin. Once you have Bitcoin, you can use it in several ways. 1. Make payments. More and more companies and online stores are accepting Bitcoin as payment for goods and services. 2. Invest or trade. Bitcoin can be bought, sold, and traded on various cryptocurrency exchanges. 10. Is Bitcoin legal? The legality of Bitcoin varies by country. In many countries, Bitcoin is legal to buy, sell, and use. However, it may be subject to certain regulations. Some countries, such as China, have banned Bitcoin, while others have yet to regulate it. Before using Bitcoin, it's important to check your country's regulations regarding cryptocurrencies. 11. The risks of Bitcoin. While Bitcoin has many potential benefits, there are also risks involved. Price volatility. Bitcoin's value can fluctuate drastically, leading to potential financial losses. Security. If you don't properly secure your Bitcoin wallet, Bitcoin could be stolen. Regulatory uncertainty. Since Bitcoin operates outside of traditional financial systems, it may face future regulatory challenges. The future of Bitcoin. Bitcoin is a revolutionary concept in the world of finance. While it's still in its early stages, its impact has already been felt globally. Whether it's seen as a store of value, a payment method, or a potential hedge against inflation, Bitcoin is likely to continue evolving and shaping the future of money. If you're new to Bitcoin, start small, do your research, and make sure you understand the risks involved. With the right approach, Bitcoin can offer exciting opportunities for both investors and users alike. If you have any questions or want to share your thoughts, feel free to drop a comment below.